GST is a tax levied on the supply of goods and services in India. It is payable by the registered taxpayers on a monthly or quarterly basis, depending on their turnover and type of registration. The GST payment deadline is the date by which the taxpayers have to pay the GST amount to the government. The GST payment deadline for general taxpayers is the 20th of the next month. For example, if a taxpayer has to pay GST for the month of January 2023, the GST payment deadline will be February 20th, 2023. The GST payment deadline for composition scheme dealers is the 18th of the next quarter. For example, if a composition dealer has to pay GST for the quarter of January-March 2023, the GST payment deadline will be April 18th, 2023. If a taxpayer fails to pay GST by the due date, he or she will have to pay interest and penalty on the late payment. The interest rate for late payment of GST is 18% per annum. The interest is calculated on the outstanding tax amount from the day after the due date till the date of actual payment. The penalty for late payment of GST is 10% of the tax amount, or Rs. 10,000, whichever is higher. However, if there is a reasonable cause for delay, the penalty may be waived by the GST officer. Therefore, it is important for taxpayers to pay GST on time and avoid any interest or penalty charges. Paying GST on time also helps in maintaining a good compliance rating and availing input tax credit benefits. The GST payment deadline is the date by which goods transport agencies have to pay the tax on their services to the government. This deadline affects the cash flow and profitability of these agencies in several ways. First, the GST payment deadline reduces the liquidity of the agencies. Liquidity is the ability to access cash quickly and easily. When the agencies have to pay the GST, they have to use their cash reserves or borrow money from other sources. This means they have less cash available for other purposes, such as paying salaries, fuel, maintenance, or investing in new vehicles. Second, the GST payment deadline increases the cost of capital for the agencies. Cost of capital is the amount of money that the agencies have to pay to use or borrow funds. When the agencies borrow money to pay the GST, they have to pay interest on the loans. This increases their expenses and reduces their profits. Third, the GST payment deadline affects the demand for the services of the agencies. Demand is the willingness and ability of customers to buy goods or services. When the GST is high, it increases the price of transportation services. This may discourage some customers from using these services or make them switch to cheaper alternatives. This reduces the revenue and market share of the agencies. Therefore, the GST payment deadline has a significant impact on the cash flow and profitability of goods transport agencies. It reduces their liquidity, increases their cost of capital, and affects their demand. These factors can make it harder for them to operate efficiently and competitively in the market. How the goods transport agencies can manage their GST payments efficiently and avoid delays or errors. Goods transport agencies, GTAs, are entities that provide services of goods transport by road and issue a consignment note for the purpose. Under GST, GTAs have the option to collect and pay GST on forward charge basis or reverse charge basis. Forward charge basis means that the GTA collects GST from the recipient of the service and pays it to the government. Reverse charge basis means that the recipient of the service pays GST directly to the government, and the GTA does not collect any GST. Both methods have their own advantages and disadvantages. Forward charge basis allows the GTA to claim input tax credit on the GST paid on its expenses and inputs. This reduces the tax liability of the GTA and increases its profitability. However, forward charge basis also requires the GTA to maintain detailed records of its transactions, invoices, and tax payments. It also increases the working capital requirement of the GTA as it has to pay GST before receiving payment from the recipient. Reverse charge basis simplifies the compliance burden of the GTA as it does not have to collect or pay any GST. It also frees up the working capital of the GTA as it does not have to pay GST in advance. However, reverse charge basis also deprives the GTA of the benefit of input tax credit. This means that the GTA has to bear the full cost of GST paid on its expenses and inputs. This increases the tax liability of the GTA and reduces its profitability. Therefore, GTAs have to carefully weigh the pros and cons of both methods and choose the one that suits their business model and cash flow situation. The government has extended the deadline to May 31st for GTAs to exercise the option of paying GST on forward charge basis for current fiscal. If they do not opt for this option by May 31st, they will have to pay GST on reverse charge basis by default. To manage their GST payments efficiently and avoid delays or errors, GTAs should follow these steps. Register for GST if they cross the threshold limit of 20 rupees lakh, 10 rupees lakh for special category states, in a financial year or if they provide services to registered persons. Choose between forward charge basis or reverse charge basis by filling a form, Annexure V, by May 31st for current fiscal or within 45 days from the date of applying for registration or 1 month from the date of obtaining registration, whichever is later. Issue a consignment note for every service provided and mention whether GST is payable on forward charge basis or reverse charge basis. Collect GST from the recipient of service at the rate of 12%, with input tax credit, or 5%, without input tax credit, if opting for forward charge basis. Pay GST to the government through electronic cash ledger or electronic credit ledger on a monthly or quarterly basis depending on turnover. File monthly or quarterly returns, GSTR 3B, and annual return, GSTR 9, online through GST portal. Claim input tax credit on eligible expenses and inputs if opting for forward charge basis by filing monthly or quarterly returns, GSTR 3B. Reconcile input tax credit with GSTR 2A, auto-populated statement of inward supplies, and GSTR 2B, auto-drafted input tax credit statement. Rectify any errors or discrepancies in returns or payments within prescribed time limits. Keep proper records and documents of all transactions, invoices, payments, and returns for at least 6 years. By following these steps, GTAs can ensure timely and accurate compliance with GST laws and regulations. They can also optimize their tax liability and cash flow situation by choosing the appropriate method of paying GST. This will help them improve their business efficiency and profitability in the long run.